Welcome to the daily update, where I'll go over the action in the market for Tuesday, June 18th, and then we'll see how things look for Thursday, June 20th. The market will be closed on Wednesday, June 19th, in observance of Juneteenth. It's kind of going to be one of those weird weeks where there's a holiday right in the middle, and it's going to throw some things off. We're still looking positive for now. We had a bit of an update. We're looking positive in the short, intermediate, long term. We're still seeing negative divergences, but at the same time, we're possibly seeing some improvements with those negative divergences, but they haven't gone away. And that's a real warning sign that we're seeing right now. But the market just keeps going higher and higher, mainly led by tech stocks and Nvidia and other stocks that have really been giving a lot of strength these days. We'll just have to see how this continues to play out. You've got a lot of people that are really suspecting that the market's going to fall from here, which is sometimes how it keeps going up because it defies human logic. We try to apply what we think is going to happen to the market, and then the market has its own way of doing things, and the two don't necessarily connect with each other on a consistent basis. Please know that the SPXInvesting Program has launched. It's free for the month of June. I'm going to be locking that down in July. If you want to learn more about the program itself, there's a playlist on YouTube. There are videos on Rumble. If you want to talk to me about this, here's an email address. There's also a link to go check out the website itself. So please feel free to peruse that when you get a chance. Let's go back and talk about what happened, and then I'll go through the charts. We did have a higher open, and prices just kind of remained little changed. The slow day that I personally thought we would see on Monday, that's how things played out on Tuesday. I thought there would be more of a reaction to retail sales, but it was really quite muted. Prices did find support at the unchanged level. We drifted a little bit lower, but then we were able to bounce up off of that. We chopped sideways for the entire session. So we ended up being up 0.25%. We're still above average with volume. Even on a day before the market's going to be closed, volume remained rather healthy. We're positive in the short, intermediate, and long term, but there are concerns with these negative divergences. Inflation and interest rates are what the market continues to be really fixated on right now. Interest rates ended up being down in Tuesday's session, and that did give some support to stocks. And we want to be aware of all the different geopolitical events. Things seem to be calming down in France. The European markets ended up having an up day both on Monday and then on Tuesday. So maybe, at least from a stock market perspective, that situation is becoming not as crazy as it seemed to be at first. Some comments. We set another set of new all-time highs with the S&P, NASDAQ, and NASDAQ 100. Any kind of an up day, it's going to produce a new all-time high. The negative divergences, they're still there. They're not going away. But are we seeing some signs of improvement? And I'll point that out as we go through. We have a pretty long list in the short term with the Stochc RSI, the Williams Percent R, the CCI 1420, stochastics, the short-term RSI based on 9 periods, and the boom indicator based on 20 periods. This list really hasn't changed. And we're wondering, as we always do, is this suggesting a short-term pullback? We're just not seeing that, at least yet. Now, that could always change. So for right now, we're kind of taking it as this is showing good momentum in the market. In the intermediate term, we're still up into that +3 channel with the standard deviation chart, so we're extreme positive there. The CMB composite, the Sean trend meter, the Chaikin oscillator, the ultimate oscillator, the percent B, we're still above that upper Bollinger Band, and then the more intermediate term RSI based on 9 periods. The Fed is still going with this idea that they're keeping rates higher for longer because inflation hasn't slowed the way they really wanted it to. If there's going to be a rate cut, and we don't know if that's actually going to happen, the market's been trying to front run these rate cuts since June of 2022, and it just hasn't panned out that way. At the beginning of 2024, it looked like there were going to be 6 rate cuts. Then it got whittled all the way down to 1, and that's where we stand currently. The dollar was down and interest rates were down. We closed at 4.22% with the 10-year yield where we had been at 4.28%. We're still inverted with the yield curve. Sentiment really didn't change. We're still negative, and that's because of these negative divergences that we're seeing, where we came in at 42, where we had been at 42 after Monday. We are positive with the trend, and it's a confirmed trend. The green line is on top. It's above its moving average, and they're both above 20. The bias is positive since we had an up day, and then the momentum the last 2, 3, 4, 5 days taken together continues to be positive. We did get retail sales, and it came in weaker than expected. Didn't really have much of an impact. It was up 0.1%. They expected it to be up 0.3%. Last time it was down 0.2%. When you take out autos, it was down 0.1%. They expected it to be up 0.2%. Last time it was down 0.1%. Industrial production came in a lot more than what they thought. They expected it to come in up 0.4%. It came in up 0.9%. Last time it was unchanged. Capacity utilization still under that 80 level. We came in at 78.6. They expected 78.5, so a little bit stronger than expected. Last time it was at 78.2, so it has gone up slightly there. Business inventories, and I don't have a chart for this one, came in up 0.3%. They expected it to be up 0.3%. Last time it was down 0.1%. So here's the chart of the core retail sales year over year, where they are declining, but they're still above zero. Then month over month retail sales did decline, but it was still positive, at least according to this reading here. We look at production, that's the blue line where it is picking up, and capacity utilization is pretty much going sideways on a year over year basis. Here's where we look at it on another chart where it's going up, but it's still above that 80% level. Here's the month over month look where industrial production really did shoot up. That was stronger than expected. And then some Isabel Net blog charts. This is the technical score. We're currently at 80.98, so almost 81, which is suggesting that we're looking overbought and possibly extreme positive. Looking at the bottom up S&P 500 earnings per share estimates year over year growth, we're starting to deal here with these quarters, and now we're forecasting out as what the consensus is going to be, and they're seeing earnings going up. And as always, that justifies higher stock prices. And then the forecast for all of 2024 going into 2025, things are still looking positive that way. And then this is the breakdown of the U.S. equity market, where households have about 39%. And I'm not going to read through all these percentages, but this just shows what areas end up owning the most when it comes to stocks. And then looking at the S&P 500 relative to the equal weight, and I go through this in every day's chart. I also go through this in the intermarket analysis video, and this is just showing when this is going up that the S&P 500 is outperforming. And this is a few days old now. This is June 12th, where I update this chart every day when I do the daily videos. And then this could actually end up being more positive for the market, because you've got a lot of people that just are assuming the market's going to go down now. It's the summer months. We're looking at negative divergences. We've had a good run up, and 17% say that they are likely to increase their exposure to equities, and that's really dropping off. So you have a lot of pessimism out there, and the market can quite often do the opposite of that. Then looking at the mega cap tech earnings per share growth, premium is now expected to narrow. Doesn't seem to have much of an impact right now. These are still just gigantuan. Yeah, that is a word. Even looking out into the future, the growth is really phenomenal. I mean, this is just beyond even any kind of reason back in 2023 and into 2024. But even looking forward, yeah, it's coming down, but it's still really, really solid. And then looking, and I don't care where you stand as far as the presidential election, but when you look at different surveys and you look at the odds, this is people that are actually putting money on the line here, according to Deutsche Bank, that are betting on who they think is going to win the election, where it looks like the light blue line is Donald Trump and the black blue line is Joe Biden. But there's still a long ways to go for that. This is the top 10 stocks as a percent of the weighting of the S&P 500. They make up 37.5%. And then the tech sector valuations exceed post-COVID highs. So we're starting to see valuations really going up here as far as the forward-looking PE ratio. but it can stay up here for a while. And sometimes the market doesn't even care if that's really happening. But at some point, it might end up being dealt with by the market. And where I had a lot of Twitter charts yesterday, I didn't really find anything. It's kind of my own mood. If I'm willing to sort through all this self-proclaimed genius wisdom to find some good stuff, sometimes I'm more able to do that than other times. Here's our intraday chart. Really sleepy day. We did have a little bit of a higher open. We stayed above the unchanged level. We came down to it once, just briefly went negative, but this ended up providing support and we just chopped sideways. Like I said, this is what I thought was going to happen on Monday. And then there would be more of a reaction on Tuesday. It was just the opposite of that. Intraday chart, not really showing us anything all that unusual right now. We are looking positive here with the blue line above the red line. On the intraday basis, large cap growth is outperforming large cap value. And when we look at S&P growth to value, it was actually down just a little bit, but we want to take a bigger picture look. We go back to the beginning of June, and we see where this has really been improving lately. And that's giving some positive undertones to the market. Here's our end of day charts where growth was up, but up less than value. It was up more for the mid caps, and where it was unchanged for the small caps with value, it was actually up slightly with the small caps when we look at growth. So not seeing much of an improvement here with small cap growth to value. Mid cap growth to value actually declined. This is where we're seeing some strength, and this is what I focus on the most. This is S&P growth to value on an end of day chart, and this is continuing to go up, and that could give more support to the market. We're also seeing the growth to value ratio is measured by these ETFs. It ticked down just a little bit, but it's really above the rainbow, and it's been performing quite well when we compare growth to value that way. Discretionary just kind of going sideways right now. Saw a little bit of a bounce up with the staples, and so we're flat to slightly declining again when we look at the ratio. Not seeing an awful lot of strength there. Large cap growth did set another new all-time high, and the large caps continue to outperform the small caps. The Wilshire, a broad market measure, setting an all-time high. Our trend is positive. The ADX is above the moving average, above 20. That suggests a confirmed trend that is strengthening. And the green line, even though it ticked down a little bit, is still on top. So that's positive. And we're seeing pretty much that same thing in the short term. So there's confirmation between these two different time frames. We're still above average with volume, so that's rather encouraging. We're just not seeing a lot of price movement, at least in Tuesday's session. The Ulcer Index continues to drop as there's not a lot of fear in the market. We don't have the latest reading from Investors Intelligence, but we did come in above 3 last time. We declined with the closing value of the VIX with the line chart, and we also closed near the bottom of the bar with the bar chart here, as we're not seeing an awful lot of fear right now. And the volatility that seemed to be picking up of the VIX, it dropped off a bit in Tuesday's session. We're still keeping an eye on the SKU index. This measures using out-of-the-money options, which is different than how the VIX is calculated. We are coming down, but we're still in this red area now. So we're waiting to see what's going to happen to actually drop this indicator down, as the market is still expecting some kind of a big move. So far, that's been positive. We'll see if there's any more follow-through with that. The momentum of the VIX continues to be up. Even though we've been declining down here, the MACD has not crossed below its moving average. The equity put call ratio did decline, but we're still going up with our 5-period chart here. The volatility risk premium is still giving us kind of a high reading right now. So there is some volatility as measured by this. We declined with this fear gauge, and we actually declined a little bit with our other fear gauge. So a little bit of confirmation after seeing them going in opposite directions the last few days. We see a little bit of a tick up here with the advanced decline line based on price, but we're still showing a negative divergence here. We are holding up a little bit better based on volume. That's actually breaking out and setting a high here. We just need to see more follow through based on price. We saw an expansion of the new highs, not enough yet to turn our 5-period up, but we're starting to go back up with the 10-period and a bit of a contraction of the new lows. So we're seeing a little bit of strength building here internally in the S&P. We're looking a little more positive with our advanced decline ratio. We're trying to turn back and look at least a little more positive. We're still slightly negative with the shorter term, where we're looking a little more positive with the intermediate term. This is still looking really solid. The accumulation distribution, we're up and we're above an advancing moving average. The concern is that maybe we're getting a little far away from this moving average. Other times when we got far away, it had a tendency to bounce back. It's the same basic premise that I use with the boom indicator, measuring how far away are we from the 20, 50, and 200 moving averages. This is positive, the chicken money flow, but maybe it's getting a little too positive. We saw this really spiking up, and other times doesn't necessarily mean a reversal, but it means that some of the smart money has really been active lately, coming in and doing some buying. They might drop off a bit with that now. When we get to an extreme reading, we're also starting to get extreme with the Chaikin oscillator. The NYSE cumulative advanced decline line so far is continuing to bounce up off its 50-day moving average, also bouncing up off the moving average with our regular NYSE advanced decline line, seeing a little bit of a bounce here with our other NYSE advanced decline line. We ticked back up based on price of the common stock on the NYSE, and also ticked back up based on volume. The cumulative S&P 500 based on price is ticking back up a little bit, but we've been holding up a little bit better here based on volume, and you could take that as positive, but we need to see more follow through based on price. We're seeing a little bit of an improvement here when we compare the S&P to the NYSE advanced decline line. It has been bouncing up. We're seeing a little bit of an improvement here with our advanced decline line studies, coming back up with the NYSE common stock, back above the moving average with the S&P, pretty much flat with the mid caps, and slightly declining with the small caps. We are above average with volume when we look at the bottom, and we're still looking really healthy here. We don't really show anything. If we fall, we might hit one of these pivot points that act as support. If we continue to go up, there is overhead resistance with other pivot points. And when we look at our short-term indicators, we are extreme positive with the Stochc RSI, the Williams percent R, the CCI 14, 20, and the stochastics. And that hasn't really changed. We're looking good here with our 20-period double and triple exponential moving averages. We're above both lines, and the lines are going up. We're seeing a bit of a turn up with our 20, 50, and a little teeny tiny turn up here with our 200. So this is showing some slight improvements here. The force index continues to be positive, and we're above both of the 20-period simple and exponential moving averages. So the short-term trend is still looking good. We're up into the +3 channel with our standard deviations chart. That could be extreme positive, but we can stay up here when we're really seeing market strength. Doesn't necessarily mean we're going to return and reverse in the other direction. We are looking a little extreme here with our boom indicator based on 20 periods. We dropped back just a little bit with the 50, and we continue to go up with the distance away from the 200-period moving average. We're still looking positive with the balance of power. The go-no-go system is positive. The highest high value is positive. The TTM squeeze is turning more positive. We're above both lines with our double and triple exponential moving averages based on 50 periods. That's intermediate term. We're still extreme with the CMB composite. The ease of movement continues to be positive. The Arun ticked back up after really dropping off here, but it's still positive since the whole oscillator is above zero. We're seeing an improvement here with the S&P McClellan oscillator, but we're still below zero. So we're continuing to decline based on price and volume. We might be seeing some improvement in that instead of just going straight down, we're seeing this start to flatten out just a little bit. We want to just keep an eye on this. It's not turning positive yet, but it is showing just a little bit of an improvement as far as the movement of the indicator. We also came back up with the NYSE McClellan oscillator, but we're still below zero. So we're declining with the summation index on the NYSE based on price and volume, actually showing a little bit more downward conviction based on volume, which is different than what we were seeing before. We were seeing volume heading down less and price heading down more. It's kind of the reverse of that right now. That could be a bit of a warning sign. We are seeing an improvement with the Swenlin trading oscillator. We're turning back up, but we're still below zero based on price. We're coming up and actually crossing back above zero based on volume. This is showing some improvement. On a momentum basis, the PMO continues to be positive, but when we break it down based on price and volume, we continue to be negative. We're seeing a bit of an improvement with the PMOs that are rising, a bit of an improvement with the buy signals, and flat to slightly declining with the PMOs above zero. We continue to be positive on a trending basis when looking at the Elder's Impulse system for the S&P. We're positive with the parabolic SAR. The shorter term slope oscillator is still positive, and now we're coming back above this line here, meaning that we could be getting extreme positive, or that could be suggesting good momentum. The MACD continues to look positive, and all of our oscillators have now switched over to positive on all the different time frames, short, intermediate, and long term. We're above all the plotted moving averages. We're not seeing an awful lot of strength here. We're not seeing weakness either, but the bullish percent index is just chopping sideways. We're positive because we're above 50, but we're just not going up currently. The NYSE bullish percent index did decline slightly, but we're still above 50, and we're flattening out again here with the NASDAQ 100 bullish percent index, but we're positive because we crossed back above 50. The money flow is extreme positive. The ultimate oscillator is extreme positive. The vortex continues to be positive. The RSI 14 and 9, they are also extreme positive. On balance volume is positive, showing some improvement here with the S&P, with those stocks inside the S&P above their 20-day moving averages. It's going up, but we're still below 50. And we're seeing a little bit of improvement here with our study. We're wondering if we're going to get some kind of an upthrust from this. We're seeing an improvement here with the stocks above their 50-day moving average, but we're still negative since we're slightly below 50. We're crossing back above 50 when we look at the 100 period moving average study. And we're still declining slightly when we look at those stocks above their 200-day moving average. The copy curve, a momentum oscillator, is positive. The Sean trend meter is extreme positive. The standard deviations chart is chopping sideways now, but it's still above its moving average, showing that we were really moving there for a while. We're still just barely extreme positive with the percent B indicator since we closed slightly above the upper Bollinger Band. Turning a little bit better here, but we're still negative. We're getting a reading of minus 122 when we take a 5-period moving average of the highs minus the lows across the Amex, NASDAQ, and NYSE. We're a little bit above this R2 level, so we want to see if we can get above that and stay above it and close on a weekly basis above that level. That would really improve things. We are positive when we look at the different trends with our Heiken Ashi, the Kegi chart, the Renko chart, and the 3-line break chart. We're seeing a bit of an improvement here, but not much. We're going sideways with our 150 period moving average and our 200, but we're not extreme. This is a bit of a negative divergence as we've been going up with the S&P, and these moving averages have been going down. We have not received the confirmation yet with the Hindenburg-Ullman indicator, at least for the S&P, but we have confirmations galore with the NASDAQ Hindenburg-Ullman, but there have been a lot of false signals with this, so we're not really sure how much we can trust this particular signal. We're still negative with the mid caps and the small caps in the short term. Everything else is positive. We're still negative with bonds in the long term. No changes with the decision point scorecard. And we saw some red and some blue or green here where the dollar went above 105, then it crossed below 105. And we're seeing the NASDAQ showing a lot of strength here, setting a new all-time high, getting above 17.8. We have the S&P setting a new all-time high. The sectors, we see financial, which I brought that out in yesterday's video. It was a little bit of a concern. We saw a bit of a bounce here in the financial sector. And when we look at consumer staples, they were up a little bit, but discretionary, that showed some weakness in communication. Another growth area that's been strong, that was down the most, where the tech sector was up slightly. And we're seeing a bit of an improvement here with our NYSE new highs minus the new lows. We're crossing back above zero. We're getting a positive reading of 27. And the equal weight compared to the S&P, we're still going up. There was really no change in the ratio, but this has really been going up, showing that the big stocks are the ones that are outperforming. The Dow had a slight update, but we're still just a little bit below this pivot point. We did get slightly above the 50-day moving average. We are still positive with the Elder's Impulse system for the diamonds. And we're coming up to this R2 level now, and we so far have not been able to get above that when we look at the NASDAQ. But when we look at the NASDAQ 100, we are above that R2 level. So that's looking a little more positive. We are positive with the Elder's Impulse system when looking at the Qs. We're positive with the momentum for the NASDAQ 100. Small caps were up a little bit here, but they continue to be range bound for 2024. And we continue to be neutral for the small caps when looking at the Elder's Impulse system. We're still below 50 with the Russell 2000 small cap index. When we look at the RSI, we're still below the 50-day moving average. The momentum continues to be negative. The mid caps coming up to their 50-day moving average, but not able to close above that. That's acting as overhead resistance. We continue to be neutral with the mid caps when looking at the Elder's Impulse system. Apple was down, a little bit of profit taking there. Tesla was down as well. Still, it's above its 50-day moving average, but we're still in a downtrend here. NVIDIA was up 3.5%. I thought there was some profit taking, but apparently that was yesterday. Still is the stock that everybody seems to be in love with. Microsoft was down slightly, but still looking solid. Meta was down as well, but still above its 50-day moving average. Amazon was down, still coming back down to its 50-day moving average. Google was down as well, but still looking pretty solid here. Netflix was up, not at an all-time high yet, but they are breaking out a bit. And the FANG index was down slightly, so it did not set a new all-time high. The financial sector came back above its 50-day moving average after seeing some recent weakness. We're still going down when we look at staples versus tech. That's what we want to continue to see if we're more positive on the tech sector. The dollar ended up being down slightly, but we're still in an uptrend. And we're really seeing a drop off here with the short-term correlation between the S&P and the rest of the world. It's dropping off dramatically with the short-term correlation and starting to fall with our longer-term correlation. And just keeping an eye on France, it was up 0.75%, able to get back above its 200-day moving average, and also bouncing back up off its 200-day moving average when we look at the French ETF. The staples sector was up and still above its 50-day moving average. And I'm plotting something new here. This is the RRG, the relative rotation graph. And this is what I go over in the weekly video. I'm trying to represent this in a little bit of a different way. This is just showing the ratio is declining. That's more short term. And we're also declining here with the green line. And this is just suggesting when we compare it to the S&P, staples are starting to underperform when this is going down. When this is going up, like we were seeing earlier on, that means they're outperforming. And I'm going to include that with all the different sector charts now. Utilities also showing some weakness when compared to the S&P. And healthcare also turning down when compared to the S&P. Energy also showing some weakness when you compare it to the S&P or SPX, the S&P 500. The total stock, U.S. stock ETF did go up, so it's setting another new all-time high. We were able to come down with the 10-year yield. We went back up with the 10-year based on price. We're continuing to decline. It ticked up just a little bit, but overall, this ratio is continuing to go down. That is positive for stocks. On a broad market basis, we're still going up with the S&P 1500 compared to short-term bonds. That means stocks are outperforming. Another broad market measure also is continuing to go up when we compare it to 3 to 7 year bonds. And we're still seeing things looking pretty good when we look at the ratio between the Qs and the S&P. Not looking good with discretionary to the S&P. Still looking good when we compare large cap growth to large cap value. So the large caps are still hanging in there, turning down, but still looking better with the mid caps, and going flat, but still looking better with the small caps. Seeing a little bit of an improvement here. We're still below zero with our 19-day advanced decline ratio, but we're crossing back above zero when we look at this based on volume. The S&P to utilities ratio continues to go up. That's positive for the S&P. And we ticked up a little bit, but we're still declining here with our staples to S&P 500 ratio. Going down is more positive for the S&P. So what's our outlook for Thursday? Again, we'll be closed on Wednesday for Juneteenth. The technicals are positive. These negative divergences are still there. Are we seeing some signs of improvements along the way? I don't know about the economic reports. They're still on the calendar and they're supposed to come out on Wednesday, but the market's closed. So I'm not really sure how all that's going to work out. And we want to keep an eye on the different geopolitical events. So that's why these are in blue here, because I don't know how these are going to end up being reported. We will get weekly jobless claims and housing starts and building permits on Thursday, but I don't know if this Wednesday stuff is going to come out on Thursday. It didn't come out on Tuesday. So we'll have to see how this all works out here. And the market will be closed on Wednesday. And then seasonality, when we look out to Thursday, we are neutral to negative with the Dow, neutral to positive with the S&P, and positive with the NASDAQ. So we're kind of running the whole gambit there. Thursday ends up being one of the more positive days of the week. And we see not some real strength here with the green dashed line when we look at Thursday during an election year for the S&P. We're now coming back into this negative time because the 17th was Monday. Now we're getting into the 18th and forward here. This could show some negative seasonality according to Tom Bowley's research. So the warning signs, we're still keeping an eye on staples and utilities as well as energy and healthcare. These are more defensive areas, not so much energy. It can go back and forth. But we want to just see if these are doing strong because that's what happened at the end of 2021. The advanced decline line is still showing weakness, but for the S&P, it's coming back above its moving average. The 5-period equity put call ratio is still going up, and growth of values looking okay right now for the S&P, but when we look at discretionary to staples, not very good. And our McClellan oscillators are showing some improvement as well as the summation indexes, but we're still negative when we look at those for the S&P and the NYSE. We're looking a little bit better with the Swenlin trading oscillator, but it's still negative when we look at that based on price. And our 20 and 50, I actually should have taken the 100 off of here. These studies are negative. The 100 was able to go back above 50. And then looking at our positive indicators, the parabolic SAR, the accumulation distribution, Chaikin money flow, and Chaikin oscillator. These might be starting to look a little extreme. The accumulation distribution is getting kind of far away from that moving average. The Chaikin money flow is giving us quite a high reading. And the Chaikin oscillator is also starting to look extreme positive. Doesn't mean they're going to turn right away, but it doesn't not mean that either. It just means that they may be getting done with their run to the upside before we see some kind of pullback in the indicators, which doesn't necessarily always mean a pullback in price, but it can mean that. Our oscillators are now positive. The bullish percent index is above 50, which makes it positive, but it's just chopping sideways. The money flow in the ultimate oscillator, the vortex, and the Copic curve, they are all positive. The financial sector had been showing some weakness, but we bounced back up to the 50-day moving average. And when we look at the NASDAQ 100, the momentum is positive, and the bullish percent index, even though it was flat, has crossed back above 50. So that is positive. So our conclusion, we're positive. These negative divergences are still there. We're wondering if some kind of rotation is actually going on, and we're seeing just slight indications of an improvement at certain places. In the short term, we're positive, but we're still extreme positive. Does that mean we're going to have a pullback, or is that suggesting good momentum? Intermediate term, this is where the negative divergences are really hitting the most in this particular time frame, and we're wondering if there's some kind of rotation going on. In the long term, we are seeing some negative divergences with the 150 and 200, but we continue to be positive. Thank you. I really hope you found this helpful. Enjoy having a day off from the stock market, and I will talk to you in the next video.